Good morning and welcome to the Coffee and Cap Rates podcast, your go-to source for New York City's latest commercial real estate insights. This program is brought to you by Ariel Property Advisors.
Hi, everyone. This is Shimon Shkury with Coffee and Cap Rates, the Ariel Property Advisors podcast. And today I have three distinguished guests. The first one is my partner, Michael Tortorici. Hi, Mike.
Happy summer, Shimon. Hope you're doing well.
Happy summer. That's a good one. Howard Raber, our director in Manhattan. Hi, Howard.
Hi, Mike. Already still happy summer, so I'll just say hello.
And our senior director, Chris Brodhead in Manhattan as well. Hi, Chris.
Good morning. Thanks so much for having me.
Awesome. So if you look at our Manhattan report, the first 6 months of the year, we've seen close to $7 billion of dollar volume, which is more than half of all New York City. So Manhattan is doing pretty well. And if you looked at our Coffee and Cap Rates total presentation, you saw several different things. You saw Class A office is doing exceptionally well. Free market buildings are doing well. You saw development and retail that have done extremely well, at least in the past 6 months and probably in the past 18. I want to start with a Class A office. That was about 75% of all office transactions in New York City, and most of it is in Manhattan, but a lot has been happening there. And the Class A, I'd like Howard to speak about, and maybe also afterward touch a little bit, if you can, in office conversions, or maybe that's going to be Mike on development, but we'll figure that out. So Howard, why don't you take it away?
Sure. Listen, office has been interesting. When you look at the past 5 years, that people wouldn't touch it during the pandemic, and then it was almost like the dirty word of Manhattan. And now you look at office and there's opportunity where Class A office, where it's the flight to quality for tenants, it's new amenities, it's better locations, better views for higher buildings and location opportunity. And you're seeing people pay the rents for that. In turn, the investors are then going to pay a top dollar for those assets. Now, you saw in Midtown on 522 Fifth Avenue, Amazon as a user paid almost $860 a foot for the building. Then you're seeing that price range happen onto the Class A because there's good revenue there. That being said, you're seeing then people look at other pockets of neighborhoods of where there could be opportunity, whether it's downtown or the Soho, Chelsea, or the Village, where there's a different type of market down there for office users. They like a different vibe. Then you'll see that price per foot vary, going back down. What's happening, though, and you just touched on it with the Midtown South, is that the Class B and Class C office stock is now perhaps going to see a little revitalization in the markets, where because of the Midtown South rezoning, where you're seeing those M zone buildings, particular, the old manufacturing properties, they're going to be repurposed as it's going through the process and allowing for that residential conversion. And you're going to see pricing really start up again for these buildings, whether it's at $300 a foot, could be less depending on these development scenarios that Mike can touch on as well as Chris. But the fact is you're bringing a lot of multifamily units into Manhattan, and then you're bringing life also into office, because you look at Vornado's doing by Penn Station, that they're going to be coming back into the market perhaps, and you want to see these pockets of commercial and residential working together. And I think it's actually doing very well for that asset class.
Thank you, Howard. And we're going to go in a second into the conversions because they're super interesting. But I wanted to double click about something you said here on a Class A, and that is the drivers. The drivers are the tenancy, the Deloittes, the Apollos that are willing to take a lot of square footage for a pretty high number. They're looking for the quality assets, the locations, the amenities, the fact that they can keep developing their strong corporate cultures in these office buildings. And the other aspect of it that, Howard, you kind of mentioned as well, from a transactional perspective, it's not only Class A office sales, it's also recapitalizations. We've seen that in many cases, like the Fisher Brothers sale together with Blackstone, or recapitalization together with Blackstone. And lastly, there has been a lot of refinances, $9 billion of refinances that took place in the past 6 months in Class A. So there's a tremendous amount of activity. And at the tail end of your remarks, Howard, you mentioned the Midtown rezoning, and I wanted to add also the City of Yes. And that brings us to talk about office conversions, but also developments in general. Mike, what can we tell about the development market in Manhattan today?
Sure. So, we've been saying, I think, for the past couple of coffee and cap rate recaps that we expected a turnaround in the development market. And I'd say that we're now seeing a more pronounced upswing. Whereas from, call it 2022 through 2024, we kind of hovered around that 400 a buildable square foot level, give or take. The price per buildable square foot came in during the first half at $488 a square foot, which is about a 15% improvement over what we saw for the year end average of 2024. And we'll see where we end up at the end of the year. But all signs point to there being another positive year of growth on a price per buildable basis for Manhattan. The 488 is the highest level we've seen since 2021, when we were kind of in a downward slide from the 600 a buildable square foot level through 19 and 20. 2020 transactions froze up, and basically whatever closed that year was a legacy pre-COVID transaction. There just wasn't a lot of trading. So we found our floor around the 400 level. Now we're back on the rise. And whereas other asset classes, the prices, they're improving somewhat, they're bouncing somewhat. I think this is a pronounced improvement that bodes well, not just for development, but for the rest of the market as a whole.
Thank you, Mike. And what's interesting when you mentioned that before is that condo developers are becoming a lot more comfortable in New York City, not just in Manhattan, but a lot of it is in Manhattan. A lot more transactions took place in the past 6 months. We've seen at least 37 land transactions that are going to be condominiums in New York City as a whole. And our capital services group is telling us that lenders are becoming a lot more comfortable with condominium development. So that price per foot you mentioned, Mike, is exactly because of that. And in some cases, I think you and I have seen higher prices per foot than the average that's a little below 500. We've seen higher than that as well. It depends on the locations.
The range remains wide. Some uber luxury locations where the sellouts are expected to be 2,500, 3,000 a square foot or higher. Those can go upwards of 650, 700. We've seen 800 a buildable square foot. Sites that are more inclined towards rental development or maybe starter condominium locations will be in the 300s. But the overall average is trending up, and it's a great sign for the residential market long term.
Great. And we are in an undersupplied market. At the end of the day, not enough of it trades and not enough of it is being built. And that undersupplied market positively affects free market buildings, existing multifamily. We know that there we have the free market world, the rent stabilized world, and the affordable housing world. And I wonder, how did Manhattan do in the past 6 months when it comes to transactions of multifamily buildings? Chris?
So interestingly enough, year over year, the dollar volume decreased by almost 20% to $1.260 billion. However, transaction volume actually rose to 97, rose by about 5%. So this points to the fact that smaller sized properties were selling generally concentrated in the East Village, Chelsea, and Chinatown. And these were primarily free market assets. 91% of the dollar volume was allocated toward free market assets, as was 81% of the transaction volume. However, we are seeing somewhat softer pricing. So the average cap rate was, for the last 6 months, 6.62%, which is 39 basis points higher than the 2024 average. The average price per square foot of free market multifamily came in at just shy of $800 a square foot. And this is, while it's up 4% year over year, it's still about 27% lower than peak values. Who are the buyers we're seeing? Institutional buyers, family offices, local operators were very active, and they're focusing really on core assets with durable tenancy, future upside, and they want exposure to the strong rental fundamentals that are found in Manhattan. So certainly an interesting market. And again, also, I think although dollar volume is down, the number of transactions are up, and that's positive.
Thank you, Chris. And you mentioned something interesting about the fundamentals. I mean, we've seen 9 to 10% growth year over year in rents, and that is what's driving predominantly free market buildings. And one of the other interesting things, Chris, that you mentioned throughout the years is that we've seen that the basis for free market buildings in general is still well below peak. So I think we've been at about 20% below the best times in the market in 2015 and 16. And that's what persuades many investors to buy today. One of the things, Chris, that I think, in the transaction you mentioned, specifically with institutions, is the fact that very similar to Class A owners, many sponsors of Class A buildings or buildings that are relatively newer want to stay in. So we've seen Taconic bringing in Eris in Hell's Kitchen on West 52nd Street and staying in the deal. So that's for multifamily. One of the things I wanted to mention about retail before we close out is that we continue to see what Amazon did based on what Howard told us just now, buying their own office. We've seen Uniqlo and Ralph Lauren buying their own stores on Prince and on Fifth Avenue. And that's a continuation of what Gucci and Prada did last year. So very interesting phenomena that's happening in retail and probably will continue to happen in retail. So in general, Manhattan, specifically below 96th Street, seems like has done well. We've identified the pockets of what's happening there, and we believe we'll continue to see Manhattan below 96th Street thrive. Any closing words from any of you, Mike, Chris, or Howard?
I agree. I think we're seeing good activity. We're seeing consistent activity. Any listing that we get has got a nice well of buyers that are active in submitting bids and looking to do deals. So the tempo is good and we think it's picking up, and look forward to continuing that through the course of the year.
Thank you so much, guys. And thank you for our listeners. We look forward to giving you another podcast very soon.